Good evening. Dwayne Lowry here for the DPP Grain Desk with a commentary on Sunday, August 28, 2011. What may be the big factors just over the horizon? In this broadcast, we will talk about outside markets, the need to ration demand, and the soybean situation. Thanks for taking the time to join me. The trade is currently focused on national yield projections, but with the calendar about to turn to September, we know that the weather will soon be of little importance as yield potential soon settles into the whatever it is category. Market rhetoric has been ratcheting yield numbers lower for the past several weeks, accelerating the downward progression during the past 3 weeks. It is difficult to believe we haven't already factored in the worst case scenario. History strongly warns that in similar circumstances during the month of August, tend to find traders underestimating the resiliency of today's hybrids. Only time will tell if that is true again this year. So for the time being, let's move past U.S. yield finalities and determine if there is anything worthy of our attention. In the outside markets, panic and emotion moves seems to be over. Some sort of stabilization will occur at a minimum. This will limit any negative influences on the grain trade for a while. Overall economic growth appears likely to be subdued, which should limit inflation-based speculative buying interest in the grain trade. Global crude oil supply concerns seem likely to ease during the next several months, and supplies will improve during a period where global demand growth is tepid. While the Fed has signaled it is willing to do something to support economic growth, they have set the conditions bar quite high, suggesting again that there could be diminishing speculative sponsorship of commodity ownership in the months ahead due to inflationary reasons, or lack thereof. Congressional focus is likely to remain on spending cuts as the election process rhetoric has made it very unpopular to talk about new spending, and therefore it is a race to see who can offer to cut spending the most. Reduced government spending is not a bullish commodity input. The U.S. dollar has been talked down for a long time, but we are at the bottom side of a 3-year stagnation range. At some point a recovery here is likely, as fears of inflation were the biggest driving theme for a negative dollar stance. With projected economic growth now, inflation shouldn't become a hot topic of discussion for at least another 12 months. Plus, as the government cuts spending, which is a theme likely to continue through the election 2012, the dollar will lose its luster as a place to be short, which, if true, suggests we will again experience a rather aggressive short covering phase here at some point, weighing further on commodity sentiment and leading to unwinding of multiple speculative long positions. As far as demand rationing is concerned, if the current U.S. corn production estimates prove to be correct, usage will have to be cut, probably by another 300 million bushels, and that's assuming a 5 bushel per acre decline from the last USDA projection. In the last USDA monthly S&D, corn usage was cut but for exports by 4% from last year. But with wheat's cheap historic relationship to corn and the much improved Black Sea region wheat of supplies, it seems that current price relationships should already be capable of achieving a larger reduction in U.S. corn exports. USDA already has lowered U.S. Feed consumption by 2% from last year, and it may be difficult to get much more of a decline there when looking at current livestock prices and margins. So that leaves U.S. corn use for ethanol to do some work. It will be very difficult to accomplish the needed corn use rationing without reducing ethanol's consumption. If that becomes a backdrop assumption, does that impact congressional action decisions regarding ethanol subsidy issues? In fact, should we ask the question that if a short U.S. corn crop adds to the political pressures to have the ethanol subsidies reduced, especially in an environment where many of the political watchers say the ethanol industry and the subsidies that have been given to it have rapidly and noticeably lost support in D.C. It is not unreasonable to view a 2011 corn production shortfall at the same time that political enthusiasm to cut spending is building to be a perfect storm capable of negatively impacting ethanol subsidies and therefore demand for the corn use for ethanol. So one of the last two questions here may be that It needs to be pondered whether the market has already achieved the price levels and dynamics to cause the demand rationing shore to be achieved. The wheat-corn ratios are at levels capable of further reducing U.S. corn exports. The political climate has already achieved a condition that should be conducive to shrinking ethanol subsidies, and this climate may be set to continue for more than a year. I believe the answer is that we have the right set of circumstances already in place to achieve the demand rationing objectives. No further price strength may be required to accomplish this. The last question that, out of respect for history and out of respect for emotions that occur in this business and crop genetics, that must be asked, is it possible that final U.S. corn production proves to be higher than whatever the current pessimism has generated for an expectation? The answer here must be that, of course, it's possible. We've seen it happen before. Similar circumstances, similar strong beliefs in the trade that the crop is smaller, only to find out when the combines roll it wasn't as bad as what they thought. If we can build a fundamental baseline that suggests we may already have achieved a price component capable of meeting demand rationing requirements, then shouldn't we view the political climate and underlying commodity speculative factors as reasons to be concerned about downside risk? If you answer yes to that question, then your job must be to calculate your profit potential using your yield expectation calculations, not somebody who stayed away, but your expectations, and determine whether additional sales create potential that just can't be passed up for your operation. Remember, current fall delivery versus next spring delivery right now doesn't offer much incentive to hold inventory, and that's probably going to be the case through the harvest season unless the crop actually proves to be larger than expected. Let's move to the soybean situation. Current yield expectations really have not declined from the August USDA estimate. While a quarter to a third of the U.S. Midwest has been dry, mild temps have limited concerns, and those other areas that have received moisture are creating improved yield optimism. Global supplies are such that it's very easy to shift demand away from the U.S. and towards South America. If you want a weather market for soybeans, forget about August 29th in the U.S. The next soybean weather market it will need to have a South American forecast. Thus, that is still a long ways into the future, and these late season weather bulls in the soybeans now will most likely be liquidated long before a South American weather scare develops. The current probe to new highs may not be on solid fundamental footing here, and it may prove to be short-lived. In summary, it's not unreasonable to see merit in the idea that prices have already accomplished much and factored in much of the known bullish influences. As producers, when harvest is just ahead, your number one job is to focus on your own profit opportunity and the impact that current prices can have on your bottom line. Don't underestimate how much work the marketplace has already done to address declining crop expectations. Also, don't ignore the possibility and historical likelihood that pessimistic trade rhetoric during August can overshoot production losses. For the DPP Grain Desk, this has been Dwayne Lowry. Thanks for your time and attention.